watching are probably kids like me, so you may not know exactly how money lending or bank deposits work. The key to it all is interest rates. Interested? So, interest can refer to a number of things, including returns on investments, such as bonds, etc. However, when you mention interest rates, you usually talk about interest as it is for the wider economy, like bank deposit returns or money lending. So, an interest rate is a percentage of money which the bank will use as a rate of charge for loans and for deposits. It's used for fiscal policy by the Fed to stimulate and stagnate the economy, in use in all worldwide states and countries such as America, where the Federal Reserve control it. Understand? No? You know what? Never mind. Let me explain. Take an example of a simple bank deposit. You may think it's just a place to store cash, like this piggy bank. You put money in it and then you take the same amount out. However, actually your money doesn't stay put. It grows in value. This is a bit of a weird concept to grasp, but imagine it a bit like this. It's like putting this £1 into your deposit, or this time pig, and pulling out £1 and 1p. Like this. It's almost as if a magician has tapped the pig to grow your money. Just like you're going to tap that like button for the YouTube algorithm. It's a small click that helps me out loads, and so thank you for that. And let's get on with the video. So, as I was saying, your money will grow in value over time. But you might be wondering, where does this money come from? Why does this happen? And why am I still shaking this piggy bank around? We're not going to answer that last one though. So, first off, this money comes from the bank's own money. And no, it's not printed or created out of nothing, or even pulled out of a dimension. It's just the bank's. Which leads us on to the next question. Why? Why does the bank pay you for your bank deposit? Well, to understand this, it might help to go through where your money starts and where it ends up. So, say you deposit $100 into your bank account. Every year, you're paid an interest on this deposit, so your money will grow in size. For example, your $100 after year one could become $101. So, in this instance, the interest rate is 1%. 1% of your $100 is $1. So the first year you would earn $1 to have a total value of $101. Do you get me? Let's do another example. A $500 deposit with a 5% interest rate would earn you blank after 1 year with a total value of blank after the same year. So here, just pause the video and try and work it out for yourself. Done? Great. So your $500 deposit and your 5% rate would earn you $25 because 5% of $500 is $25. And so the total value would be $525. If you didn't get that, rewind the video and rewatch the explanation again. But that's not everything explained about the deposit. I'm glossing over the specific details here, so make sure to watch out my follow-up video on interest rates and deposits, etc. But in essence, some of the money you put in the bank is lent out by the bank. Again, an example. Say you've deposited $100 into your savings account. The bank can now lend out, let's say, $90. As I said before, they'll lend it out at a higher interest rate. So let's say this is a 5% loan on the $90, which they loan out from your $100 deposit. Do you follow me? Again, if this doesn't make sense, make sure to rewind and watch it again. So, when they loan out the $90 to the borrower who borrows this from the bank will receive $4.50 from the borrower each year as an interest. This is the 5% on the $90. So, when they loan out the $90 to the borrower who borrows this from the bank will receive $4.50 from the borrower each year as an interest. This is the 5% on the $90 loan. So, after paying you, the depositor, the $1, the bank will get a $3.50 profit on your $100 deposit. So, that all makes sense, hopefully. It now tells us why the banks give us this interest rate. It gives us an incentive to deposit our money, which in turn allows banks to make more profit and helps borrowers to borrow more money easily from the banks. This also creates something called the money multiplier effect, which I will go over in a future video. But this still doesn't answer the question about why there even is an interest rate and what it's used for. Well, for banks and lenders and us, interest rates fight the effects of inflation, which is, again, on my long list of future videos. So watch out for that. Inflation is basically the time value of money, where money now is worth more money than money later down the road, like next year or the year after that. Basically, the purchasing power of $1 averagely goes down. So a car which is, let's say, valued at $10,000 now may be bought at a market price of $12,000 next year. So with interest rates, banks, lenders and depositors can have a steady growth on their money, which will counteract the inflation. This is the difference between nominal and real interest rates, which will also be included in my follow-up video on interest rates. Another reason is that the central bank, so for the US, that's the Fed, needs something to be able to stimulate and stagnate the economy. So if you actually heard what I said at the start, you already know that. There is a more detailed way in which the Fed manipulates interest rates, but right now just think of it as the Fed like pulling a lever up and down, like so. So when interest rates are low, people want to spend more because the gain of holding money in a deposit is less than if interest rates were higher. With lower interest rates, borrowing is also easier, so that increases spending as well. And it's vice versa with high interest rates, which decrease spending and increase saving. Okay, so currently in the US, interest rates are all the way down to 0%, or close to, which is because the Fed is trying to boost spending to kickstart the economy, especially after the effects of the COVID-19 pandemic. And in the UK, it's a similar situation, with interest rates of 0.1% for the same reasons. So, you're not going to really be making much money from a savings account right now. Another few things. First of all is the concept of compound interest. This is really important, especially when interest rates start to rise again. Albert Einstein himself actually said that compound interest was the most powerful force in the universe. It's debated whether he actually said this, but whether he said this or not, there is no doubt that compound interest is a brilliant thing because of its exponential growth. Probably the simplest explanation of compound interest is by Benjamin Franklin. Basically, he said money makes money, which is the interest on the money, and that money that the money makes money. Okay, this is a bit confusing, but so in the context of a savings account, $100 at 5% interest rates would make $5 in the first year. You might think this would be constant over every year. You get $5 every single year, but this is not actually the case. Because the $5 interest from the first year will also earn interest in the second year. So after the second year, you will actually earn $5.25 instead of just $5. And then $5.51, and then $5.97. And by the time you get to the 17th year, your interest would have doubled along with your money, with a value of $218.29 and an interest of $10.39. The next thing is just a quick aside about interest rates. I know I said earlier that the US interest rate was 0% and the UK's was 0.1%. Actually, I lied. The way the central bank changes interest rates is complicated, so the interest rate is never set in stone. For a savings account, the interest is different to a borrowed money interest, which is higher for banks to make profit on the borrowed money. The borrowed money interest can also fluctuate on its own as well, depending on the borrower's credit score, what they're going to be buying, his reliability and its collateral, etc. So in reality, the central bank sets the interest rates, but banks can fluctuate slightly around this area to make profit and to set themselves apart from other banks. So that's deposits, borrowing and interest, in a nutshell for kids. If you found this video helpful, make sure to smash that like button and subscribe to support my YouTube channel. Watch out for the follow-up video on this topic, and thanks for watching. Until next time.